everybody. On these videos, we're going to talk about differential analysis and product pricing. And I'm hoping to get through bottleneck operations, maybe make or buy, and we'll see how far we are with discontinued operations. So my first situation is a bottleneck. Bottleneck operations means that we are at capacity and we're having to figure out where we need to market our information. How do we need to get to that? So what I have here is we have a high, medium, and low grade of steel that we produce. The furnace operations at 100% capacity. They can't get any more production in there. They have variable cost of $15 per process hour, fixed cost of $200,000, and they're telling us that our budgeted units produced are 5,000 for each the high, medium, and low. They're giving us our total process hours per unit, our furnace hours per unit, our unit selling price, and our direct material cost per unit. And I want to figure out, like, again, how do I want to market this? So first, let's just see what our contribution margin per unit is. And we have over here, we have our unit selling price, because remember, your contribution margin is your selling price minus your variable and direct material costs. So we have 280, 270, and 250. Now to get the variable conversion cost per unit, we're going to take the $12 times the $15 per process hour for high. For medium, 11 hours for processing for medium times our $15 per process hour. And we have 10 times our 15. Okay. Then our direct material cost per unit, they give us, that is the $90 for the high. We'll put $84 for the low and 84 for the medium and 80 for the low. So I can add my variable and my direct, add those together. And my contribution margin is taking my selling price minus my cost. I'll just copy that over. So contribution margin is showing that we have $10 per unit for high grade. Medium grade was 21 and low grade was 20. So we would think by just looking at this that we should advertise more for our medium, then go to our low, and then go to our high. But what we also want to look at is what is the difference when the part that's a bottleneck is our furnace, because our furnace operations are 100% capacity. So let's bring down those contribution margins per unit that we figured out here. And what we can do is we can divide that by the furnace, the bottleneck hours per unit. So we have 4 hours per unit for high, medium is 3, and low is 2.5. So I can divide that out, take the 10 divided by the 4, take the 21 divided by the 3, and the 20 divided by the 2.5. Okay, so if we look at that, we have a different contribution margin, and I just looked like I just spelled margin wrong in there. Apologize for that. Our contribution margin per furnace hour. So how we want to advertise this, we want to market our low grade first, our medium grade second, and our high grade, because we're not getting as much per contribution margin on our high, so we might as well try to earn our most profit on the low, then the medium, then the high grade. Okay, so that is when we have a bottleneck situation. Now let's look at a make or buy situation. So this company makes bread for their restaurant. Okay, it costs them $165 per 100 units of bread. Their fixed costs are $43, and an outside company has offered to sell them the bread at $110 per unit, 400 units, and $15 per delivery. So right now, that looks pretty good. That's $125, and we're at $165. Well, what we need to do is we need to figure out our differential analysis on how this is going to affect our income. Okay, so we're going to do the make, and we're going to do the buy, and we're going to check the difference out. So if we make it, there's no purchase price. If we buy it, there's $110 that we have to pay. So we look at our difference between our make and our buy. So right now, it's going to cost us $110. It's going to affect our income by $110. Okay, delivery, we do not have a delivery cost if we make it. If we buy it, it's going to cost us $15. Okay. Now, our variable cost, that's going to be the difference between your $165 and your $43. So we have $122 worth of variable cost if we make it. If we buy it, we don't have that cost in there. So again, I'll just copy this down because it works the same. And I like to get these in format. Okay. Now, fixed overhead. On this situation, we're going to say that no matter if we make it or we buy it, we have the same dollar amount in fixed costs. So either way, that's going to be netted. We're not going to see a difference. So if we take on here, let's add those up. Let's add our buy, and let's look at the difference. So what we have on here is if we buy it, we're going to lose $3 per 100 units if we buy it from a different company, outside company, versus making it at $165. Okay, this is one analysis that you can do just to determine, is it worth it? One thing that managers will look at versus make or buy, when you buy something, do you still have that quality control that you're normally used to? Maybe you do, maybe you don't. Okay, so that's just a real kind of simple explanation of how to make or buy. Now, how about we go to a discontinued product? Okay, I have a company, they're looking at a product line, the income statement shows a recent loss. So they had sales of $390, cost of goods sold $184,000, gave them a gross profit of $206,000, but they had $255,000 worth of expenses, giving them a loss of $49,000. Okay, they're telling us that 20% of the cost of goods sold represents fixed factory overhead, and 30% of the operating expenses are fixed. And the company wants to decide, should they discontinue with the product line. They're also telling us fixed costs would not be affected if they were to drop the line. So what we want to do, again, we want to do a differential analysis to determine, do we continue making this product that we have a negative $49,000 loss, or we discontinue it. When we're looking at this one, we're going to be looking at the difference between the discontinued and the continued. I'm just going to let me copy this formula down. We don't have anything in the cost. Okay, we'll actually continue that down here. So I'm just going to get that in there. Okay, so if we continue, our revenue is still going to be $390,000. Okay, if we don't, we're going to lose $390,000 worth of sales. So let's look at our variable cost. Now it said 20% of the cost of goods sold represents fixed factory overhead. Okay, so I'm going to look at that cost of goods sold. Since I'm only looking at variable, I'm going to take the $184,000 and I'm going to take it times 0.80 because 20% of that is fixed. Okay, we're not going to have variable cost. Operating expenses, they said 30% of the operating expenses are fixed. So we're going to look at our operating expenses, and we're going to take that times 70% because 70% of that is variable. The balance of it is fixed. So then if we discontinue it, we're not going to have that amount. So our fixed cost. So we got a little formula here. We need to get the balance. Remember, cost of goods sold, 20% of that is fixed, and operating, 30% of that is fixed. So I take my cost of goods sold, I take it times 20%, plus I take my operating expenses times 0.30, add those together, I have 113,300. Now they told us here fixed costs would not be affected if they were to drop the product line. Okay, so that same amount goes there. So now we can look at the difference between, we can take our 390 minus this, minus our expenses. Notice this right here matches. We need that too. Okay, I'm going to just copy that formula over because we have 113,300 of fixed costs that we still have to account for. So on this, if we were to discontinue this operation, our net income would be negative 64,300 versus if we continue it, $49,000 loss. So you're going to want to keep this line. You're going to want to continue this product. And what you can do now is kind of research what is costing. Our operating expenses were $255,000. Can we adjust that in order to have a profit versus a loss? So that's kind of what we're doing when we're looking at a discontinued operation. So those are my videos for differential analysis and product pricing, and I hope you enjoy it.